You just incorporated your medical professional corporation. You've got your articles and bylaws, probably a big package from your lawyer, and you're thinking, what do I do now? As an Alberta CPA, this is exactly what I walk physician PC clients through on day one. Here are the 10 most common questions I get. Let's go. Number one, I just got my articles of incorporation. What do I actually do first? First thing, open a corporate bank account. Take your articles of incorporation to your bank. They'll set up an account under your corporation's legal name. You need this before anything else. Income can't flow in and expenses can't flow out without it. Second, confirm your CRA accounts. Your corporation has a business number, and under that number, you'll have separate program accounts for different purposes. The main one, your corporate income tax account, the RC account, is likely already open from the incorporation process. But your payroll account, the RP account, you'll need to open separately unless your lawyer or accountant already did. You need that before you can run payroll. And there's also a third account, the RZ account, which you'll need when it's time to pay dividends. You can open it right away while you're setting up everything else, or you can wait until your accountant says it's time for dividends. Either way is fine. And one more thing, make sure you can actually log in and access your CRA My Business account for your corporation and your CRA My account for your personal tax. That's how you'll see what CRA sees. Your tax accounts, your balances, any correspondence or mail from CRA, and who your authorized representatives are. You want to know who has access to talk to CRA on your behalf. So make sure you have working access to both of those CRA accounts now. Number two, do I need a separate bank account? And should I get a business credit card too? Yes, you absolutely need a separate bank account. Your corporation is a separate legal entity from you. Mixing personal and corporate money is the single fastest way to create problems, and it makes everything harder to track down the road. Pick the simplest, cheapest business banking plan available. You can always upgrade later once you know what you need. There's really no need to overthink this. And yes, ideally get a business credit card tied to the corporate account. While it's not strictly required, I consider it the gold standard. When your expenses run through a corporate card, everything stays clean. You're not running personal and business charges through the same card, trying to sort it out later. A little bit of separation now really does save a lot of headaches at year end. Number three, how do I actually get money from my corporation into my personal account? Here's a concept that I like to use to try to make sense of things. Think of two red lines. When income comes in from Alberta Health or wherever you're billing, it crosses a red line and goes into your corporation. That's a taxable event at the corporate level. When money goes from the corporation to you personally, it crosses a second red line. That's a taxable event at the personal level. Your job with your accountant is to manage both of those crossings as efficiently as possible. Now, there are two main ways to get money out, salary or dividends. Most of my clients use what's called a bonus down strategy. Here's how it works. During the year, you'll pay yourself a consistent monthly salary through payroll. Think of it as your personal baseline, the amount that covers your mortgage, your living expenses, your life. We pick a number and it goes out every month like clockwork. Then, close to year end, we look at the full picture. How much did the corporation earn? What do we want the corporation's taxable income to be? And we calculate a year end bonus. Other accountants may call this a bonus up because you're topping up your salary, but really what you're doing is bonusing down the corporate taxable income, getting it low or close to zero. You want to get the income out to you personally in the most tax efficient way so you can actually use it, because income retained in the corporation doesn't pay your mortgage or your groceries. For most newly incorporated physicians, the bonus down to near zero corporate income is the default plan. It's where you start. Number four, what's a shareholder loan and why does my accountant keep mentioning it? Remember that red line between you and your corporation? Your shareholder loan account is the running tab that tracks every time money crosses over it. If you pay yourself a salary through payroll, that's nice and clean. It's already recorded properly. But let's say money crosses that line outside of payroll. You send yourself an e-transfer or you just buy something personal with corporate funds. that gets tracked in your shareholder loan account. And here's where it matters. If the balance, meaning you owe the corporation money, stays outstanding for too long, CRA can treat it as if the corporation paid you income. They'll tax you on it as if you received it personally, and they'll charge you tax and interest from when you initially received it, sometimes reassessing prior tax years. That's the trap. Now, the best practice, and I can't stress this enough, is to keep corporate money corporate and personal money personal. Don't use the corporate account or corporate card for personal expenses. It makes your record significantly more complicated. Sometimes you'll pay a legitimate corporate expense with personal funds. That definitely happens. And it's fine. It just goes in the other direction on your shareholder loan, where the corporation would owe you. But the cleanest setup is simple: corporate expenses through the corporate account, personal expenses through your personal account. Now, this is a really common issue in PCs, and things can get complicated quickly. It's best to try to maintain a clean separation from day one. Number 5, what expenses can I run through my corporation? CRA's general rule from the Income Tax Act is actually pretty straightforward. An expense is deductible if it was incurred for the purpose of earning income from your business. That's really the test. For most physician PCs, that includes your CMPA fees, college dues, continuing medical education, conferences, courses, travel for CME, office supplies, medical equipment, if you have any, your phone if you use it for work, and a home office if you have a dedicated workspace. The key is that it needs to have a genuine business purpose. Your corporation can't pay for your personal gym membership and call it a business expense. But legitimate practice expenses, yeah, run them through the corporation. That's what it's there for. Number 6, do I need to set up payroll? That sounds complicated. Yes, you do need payroll. As we talked about earlier, you need a CRA payroll account, the RP account. You need that set up before you can run your first pay. If you're paying yourself a salary from your corporation, and you probably will be, that means source deductions, CPP contributions, T4 slips, and remittances to CRA. It's a legal requirement. But here's the thing: you're not running payroll for a clinic with 15 staff. You're running payroll for maybe one person, maybe two, if your spouse is on payroll. It's pretty simple in scope. That said, a very high percentage of errors I see in my practice are payroll related. Missed remittances, wrong calculations, late filings. These are expensive mistakes with real penalties. The penalty rates for payroll specifically are fairly high. They're pretty onerous penalties. Um, that's exactly why I set up clients on WagePoint. It's a cloud payroll platform. It handles the calculations, remittances, direct deposits, pretty much everything. It pretty significantly reduces the scope for payroll mistakes, but it's still a tool. You still need to use it correctly. However, it does take most of the easy mistakes off the table. And here's another specific pitfall to watch out for. If you're running your own payroll, make sure you're not remitting employment insurance premiums. As a physician paying yourself through your own PC, you're very likely EI exempt. You can't claim EI benefits, so you shouldn't be contributing to it. This is one of the more common mistakes I see: physicians paying EI through their PC for years, and that money is simply gone. You don't get it back. To wrap things up on payroll, pick a monthly salary number you can sustain, set it up in WagePoint, and you'll have a much smoother time approaching year end. Number 7, what's a minute book, and do I actually need to keep it updated? Now, your minute book is your corporation's official record book. It holds your articles of incorporation, your bylaws, your share certificates, your director and officer resolutions. I know it sounds like busy work. Not quite. Your bank may ask you for it if you're applying for financing through your PC. If you ever restructure your corporation or wind it down, you'll need it. Maintaining it regularly can catch small issues before they become expensive problems. Now, here's something that many physicians may not realize: a lot of information about your corporation is public record. In Alberta, anyone can run a corporate registry search for $10 to $15 and see your corporation's legal name, your directors, your voting shareholders, and your registered office address. I know physicians tend to value their privacy, and rightly so, especially in sensitive practice areas. So if you're using your home address as your registered office, that means your home address is publicly searchable. I see this more often than you'd think. Use your accountant's or lawyer's office as your registered office instead. And be thoughtful about the contact info you put on your corporate filings. Use a dedicated business email, not your personal one. One more thing, you need to file an annual return with Alberta corporate registries every year to keep your corporation in good standing. This is separate from your tax filings. Miss 2 consecutive years and your corporation can be struck from the registry, and reinstating it is expensive and time consuming. You don't want to let that happen. Your accountant or lawyer may be taking care of this already, but just make sure it's on someone's radar and doesn't fall through the cracks. Number 8. When are my corporate tax deadlines, and what happens if I miss them? Now, there are multiple sets of deadlines you need to manage with a PC, and it's easy to mix them up. You've got your corporate tax filing and payment deadlines, your corporate payroll remittance deadlines. You may also have corporate tax installment deadlines and even personal tax installment deadlines. These are all separate and they all have their own due dates. For the corporate side, your tax return, the T2, is due 6 months after your fiscal year end. Your corporate tax payment is due earlier, generally 3 months after your year end. The catch that trips people up is that the payment is due before the filing. So if your year end is December 31st, your tax payment is due at the end of March, but your return isn't due until the end of June. You may need to estimate what you owe and pay it before you've even finalized the return. Every missed deadline can mean penalties and interest, and they can add up fast. So having a calendar with all of these deadlines, corporate, payroll, personal, is genuinely one of the most important things you can do. Or better yet, have someone else managing them for you. Question 9. Do I need an accountant right away, or can I figure this out myself at first? If you've already incorporated, you can handle the first few weeks yourself. Opening the bank account, getting organized, none of that requires an accountant. But if you haven't incorporated yet, I highly recommend you talk to an accountant or an experienced corporate lawyer before you incorporate. Some of the decisions you make during incorporation, like your share structure, your shareholders, can affect your future tax planning options significantly. It's much easier to set these up right from the start than to restructure later. Once you're incorporated, the earlier accountant gets involved, the better. I regularly see physicians try to deduct expenses that were incurred before the PC even existed, and that's a hard no. Those expenses belong to you personally, not to the corporation. My honest advice, if you're already incorporated, get an accountant in place before you start paying payroll. If you haven't incorporated yet, get one involved before you do. I know I'm biased as an accountant, but it's just like talking to an ER doc about extreme sports, where they've seen firsthand what can go wrong. Lastly, number 10, should my spouse be involved in my corporation? Short answer, ideally yes, but with some important nuance. Functionally, in most physician households I work with, the spouse already plays a significant support role, somewhere between CFO or a general manager. They're often helping manage household finances, coordinating with the accountant, and handling admin tasks for the practice. This is especially true when the spouse doesn't have outside employment. From a tax planning perspective, having your spouse involved opens some real doors. In Alberta, under CPSA rules, your spouse can be a non-voting shareholder of your medical professional corporation. You keep the voting shares, so you control the corporation, but your spouse holding non-voting shares opens the door for dividend planning. If your spouse is on payroll for legitimate work they're actually performing for the corporation, that opens the door for salary or wages that are very likely going to be taxed at a lower marginal tax rate than yours. But, and this is important, CRA has tightened the rules around this significantly. The tax on split income rules, known as TOC, or you may have heard the kitty tax rules, changed the game starting in 2018. The days of putting family members on the payroll for doing nothing or paying a phantom salary to whichever child had the lowest tax rate are essentially over. Any involvement needs to be real, documented, and reasonable. So should your spouse be involved? In most cases, from a tax planning perspective, yes. But how they're involved and how it's structured matters enormously. This is a bigger topic for a future video. There's a lot of nuance here. All right. I hope that was helpful. If there's something I didn't cover or you've got a situation that doesn't quite fit into what I described, uh, please feel free to drop it in the comments. That's where my ideas for future videos come from. Also, feel free to like and subscribe if this was useful. Thanks for the great work you do, and I'll see you in the next video.